Economist here. So, I have stated many times on this channel that I follow the Federal Reserve speeches because the Federal Reserve speeches are very telling of what's going to happen with the monetary policies. So, I thought it would be kind of a fun video to try and do as far as reading through one of these speeches and talk about some of the situations that are taking place. Because, like I said, what's going on in these speeches is very telling of what's going to be coming from the monetary policies coming into the future. So this first speech, this was given September 9th, 2022. So just, what, 3-4 days ago? And this one was from Christopher Waller, and it's called The Economic Outlook, Time to Let the Data Do the Talking. And when you start going through, I'm going to leave two speeches down in the description for you guys. One of them is from this guy Waller, and the other one's from Brainerd. And when you read these speeches, it really is pretty telling of what's going to come into the future. So I'm not going to read the very beginning. I'm going to kind of start the speech here a little ways into it. We're going to read a little bit and then kind of talk about it. But it says here, my subject today is the outlook for the U.S. economy and the Federal Reserve's ongoing campaign to bring down inflation and achieve our 2% objective. There are three takeaways from my speech today. First, inflation is far too high and is too soon to say whether inflation is moving meaningfully and persistently downward. The Federal Open Market Committee is committed to undertake actions to bring inflation back down to our 2% target. This is a fight we cannot and will not walk away from. The second takeaway is that the fears of a recession is starting in the first half of this year and faded away, and the robust U.S. labor market is giving us flexibility to be aggressive in our fight against inflation. I think about that particular sentence right there. The robust U.S. labor market is giving us flexibility to be aggressive in our fight against inflation. And now you think about it, the labor market, and gives them the ability to fight more aggressively. What is that saying? It says that they could fight this inflation with higher interest rates and not have to worry so much about people losing their jobs, even though that's what the Federal Reserve is going to be looking for. But that's kind of what he's saying right there, is that, because we have this tight labor market, it gives us the ability to go ahead and raise these interest rates. And if people start losing their jobs, well, there's plenty of jobs out there for them. So anyway, let's see here. For that reason, I support continued increases in the FOMC's policy rate, and based on what I know today, I support a significant increase at our next meeting in September 2021, or September 20th and 21st, to get the policy rate to a setting that is clearly restricting demand. The final takeaway is that I believe forward guidance is becoming less useful at this stage of the tightening cycle. Future decisions on the size of the additional rate increases and the destination for the policy rate in this cycle should be solely determined by the incoming data and their implications for the economic activity, employment, and inflation. So he said right there that the forward guidance is no longer being the useful tool it once had. I mean, this is something to think about because, all right, I got a call coming in there. This is something to think about because when you have like, let me see if I can kind of explain this one a little bit better. The forward guidance is really what determines where the monetary policy is going to go. Because you think about it, like, a lot of the economists are saying that the economy was reacting before the Federal Reserve moved their target rate, before they started moving the Fed funds rate. And a lot of people were saying that the Federal Reserve is not in control, and you could see it right there, that the economy was moving before the Federal Reserve did. But that wasn't because the Federal Reserve wasn't moving. The Federal Reserve gave out that forward guidance, and the market started reacting to that. Then later, the Federal Reserve did move with their Fed funds rate to meet the expectations of the market from what they had told them. So it wasn't like the market was moving without the Fed's information. I mean, the Fed gave out information, the markets reacted to it, and then the Fed went ahead and did their lifting of the interest rates. And what he is saying is that forward guidance, that's no longer a useful tool for them. And in fact, I disagree with that immensely, because they said they stopped using the forward guidance, and then all these speeches come out where they talk about how they're going to be lifting the interest rates. I mean, he just said it, that they needed to be, what did he say? For that reason, I support continued increases in the FOMC's policy rate, and based on what I know today, I support a significant increase at our next meeting in September 20th and 21st. So that's forward guidance right there. I mean, it may not be the official forward guidance coming from the Federal Reserve, but when you have these people who are sitting on the FOMC, policy meetings, and they have this belief that they want to raise interest rates going into the future, well, then most likely they're probably going to be raising rates going into the future. All right. So based on all the data that we have received since the FOMC's last meeting, I believe that the policy decision at our next meeting will be straightforward. Because of the strong labor market, right now there is no trade-off between the Fed's employment and the inflation objectives. So, because basically saying that if you raise the interest rates, you're going to cause a bunch of unemployment, right? A bunch of people getting fired. He's saying that's not a problem right now, because the labor market is so tight. There's so many jobs out there that they could go ahead and raise the Fed funds rate. And if they do start damaging jobs, it's not a big deal, because everybody can just go find work someplace else. That's what he's saying here. Because of the strong labor market right now, there is no trade-off between the Fed's employment and the inflation objectives, so we will continue aggressively fight inflation. Inflation is widespread, driven by strong demand that has begun to moderate, by an ongoing lag in the labor force participation, and by supply chain problems that may be improving in some areas but are still considerable. You hear that supply chain breakdown, right? That's what I've been saying the whole time. For these reasons, I expect that it will take some time before inflation moves back to our 2% goal, and that the FOMC will be tightening policy into 2023. But the answers to the questions of how high and for how long will depend solely on the incoming data. So for the rest of 2022, we got more interest increasing in the interest rates, and going into 2023. I mean, he says it right here. All right, since I spoke in July, I think the argument that we entered a recession in the first half of 2022 has pretty much ended. We didn't. Right? Well, I think that's still a little bit we can still argue that one a little bit. But anyway, according to their numbers, they're not in a recession, right? We're not in a recession. With each passing week, the absence of any indication of a recession in spending or employment data buries that recession argument a little deeper. But this is obscured. I mean, the employment and the demand that's coming from this economy are completely obscured, right? It's not real, but yet they're going off of this information. We understand that some of the factors that lowered the gross domestic product numbers in the first half, and a debate continues about other possible factors such as mismeasurements, which I believe is probably more likely, potential underreporting GDP. What we can say is that after the Fed telegraphed its policy pivot to tighten in the later months of 2021 and began raising rates in the first quarter of this year, demand and economic activity slowed in the first half of 2022 from the strong pace of 2021. Data suggests an uptick in consumption growth in the third quarter. Meanwhile, Atlanta Fed's GDP Now model forecasts real GDP grow 2.6% this quarter, though other estimates are in touch below this prediction. So they're trying to use that information to say that we're not in a recession, and that the fear of a recession is really not there, and that we're going to actually be growing into 2022 by the end of this year. I think time will tell on that one. All right. Let's see. What time are we at here? 8 minutes. Okay. Spending data in supportive of continued expansion. Nominal retail sales overall were flat in July. But that is mainly because falling gasoline and auto prices, which is good news, held back sales in those sectors. So they're trying to use the falling gasoline and auto prices as a capping for prices going up. All right, let's see here. Excluding that, retail sales rose 0.7%, suggesting that discretionary spending grew solidly. Businesses also continued to expand production and spending. Total industrial production increased 0.6% in July, standing 3.9% above its level a year ago. Forward-looking indicators of manufacturing activities such as new order indexes is various manufacturing surveys are softer than earlier in the year, but most, and in particular the positive August reading from the ISM, are not suggestive of material pullback in manufacturing activity. I very much disagree with that. I think we are going to find a significant pullback in manufacturing as those orders are that he was talking about start to drop. They're going to drop significantly, and that there's going to be a whole lot less manufacturing taking place. You can kind of see it already, not kind of, you can definitely see it taking place in China. All right, moving on here. But there are signs of moderation in the economic activity, which is what the FOMC is trying to achieve by tightening monetary policy. Not surprisingly, higher interest rates this year are slowing activity in the housing market. Yeah, right? Not surprising at all. There have been declines in construction of single-family homes for a number of months, with permits and home starts both decreasing in July. Now, that's something to think about. There has been a decline in construction of single-family homes in a number of months for a number of months, with permits of home starts both decreasing in July. So that's something to think about. Like when people ask about, like, where's the housing market's going to go and if we're going to have a crash, well, you have to have more inventory coming onto the market. Now, yes, we are having an increase in inventory, but it's the new construction, bringing new homes onto the market, that's going to really bring in the inventory that we would think would bring down the housing market. And there's less new homes being built. So that's actually not a good sign for the housing market as far as like bringing prices down. Anyway, moving on. Sales of existing and new family homes have also slowed. Existing home sales fell by 5.9% to a seasonally adjusted annual rate of 4.8 million homes in July. With an imbalance between housing supply and demand remains significant. It has meaningfully improved. The inventory of unsold new and existing homes has more than doubled since January. So, like an increase in inventory there. While the 3-month supply of existing homes is still below levels before the pandemic, the 11 months of new home inventory is the highest since the spring of 2009. So it appears that there's quite a few homes on the market now, and comparing it to back to 2009, which I'm not sure the difference between 3-month supply and 11-month supply, but I guess I'll have to, kind of contemplate that one for a little bit to figure that one out. But anyway, this later statistic has raised concerns by some about a significant downturn looming in the housing market, but an important caveat is that much of the current elevated inventory reflects the recent low rate of housing completions due to continued supply constraints. Many of these new homes for sale are still under construction, and as supply constraints ease, builders will be able to deliver more completed homes to the market where supply of existing homes remains tight. All that said, the housing market is a significant channel for the monetary policy, and I'll be watching this sector carefully. So I've said that quite a few times, that the completion of homes has been very difficult over the last, couple of years, especially since the pandemic kicked in and the supply chain of lumber broke down. The completion of homes has been very difficult, but they're starting to happen. So you can imagine that there's going to be, at some point, like more homes being completed at a pace that is increasing because of the slowdown in distribution that was happening as far as the availability of labor and supplies and stuff like that coming into the housing market. So we don't know exactly what that is going to look like, but even the Federal Reserve is starting to recognize that that's going to be an issue. All right, the FOMC's goal is that tightening in monetary policies slows aggregate demand so that it is better aligned in better alignment with supply across all sectors of the economy. That is something that we have talked about quite a few times on here. Think about what they are trying to do. They had a supply chain breakdown. There was less stuff going through the system. When you have an inventory depletion because you are not able to get that supply through the system, then you have a supply and demand imbalance where the supply is now way less than the demand. Then demand causes the prices to go up due to this lack of supply. But it was a supply chain breakdown that did it. Right? So now what they're saying here, right there at the very beginning, that the monetary policy, tightening in monetary policy slows aggregate demand so that it is better alignment with the supply across all sectors of the economy. So even though we had the supply chain breakdown, that's really was the reason why we saw the increase in prices from all the demand out there and this lack of supply. What he is saying now is that they're going to take down the demand to meet that supply. right? So here you are, you're a store, you're an entrepreneur, you're somebody who wants to be in business selling things, and you have the Federal Reserve saying right there that we want to take out the aggregate demand. We do not want people buying stuff. So if you're an entrepreneur, a store, or somebody who's looking to distribute, does this seem like the environment that you would want to invest into? I don't think so. All right, moving on. My expectations is that strong household savings and a tight labor market and additional availability of manufactured goods as supply chain constraints continue to resolve will allow households to make long-awaited purchases, which will provide a partial offset to the tighter monetary policies. That will support a slowing rather than a contraction in demand. So what they are thinking right there is that as the aggregate demand slows down and the prices, I guess, would slow down too, or come down as well. What they're saying is that the savings from households and waiting for and holding back on long-awaited purchases, which will provide a partial offset to the monetary tightening policies. So I guess their idea is that people have been saving, right, waiting to make a purchase going into the future, like holding back on those expensive things, waiting for the prices to come down. And that's what he's expecting, is that when the prices start to come down, that all this demand is going to come out of savings for these people. But I was just reading an article. In fact, after I upload this video, I'll go and grab that article and I'll leave it in the description of here. But it's something like, I forget, it was 54% of Americans who earn $50,000 to $100,000 a year now live paycheck to paycheck. And I forget, it was something like an ungodly amount of people over $250,000 also live paycheck to paycheck. So it's like almost everybody, like not almost, but like better than half of the United States lives paycheck to paycheck. I don't know where the Federal Reserve anticipates people are going to be pulling money out of savings to go, spend out there into the economy to offset the tighter monetary policies, but that's kind of what they're expecting there. Okay, anyway, continuing on here. Turning to the very strong labor market. Private payroll employment has been increasing at an average of nearly 400,000 a month over the last several months. Unemployment rose 0.2% in August to 3.7%, in a part reflecting an increase in a labor force participation rate, but still stands at a very low level. The increase in participation was a welcome news, but this rate is still far below that achieved before the pandemic, when unemployment was roughly as low as today. We are facing worker shortages in many sectors of the economy. Job openings have started to decline a bit, but remain very elevated. These data confirms that the Fed is hitting its full employment mandate, so all my attention is on bringing inflation down. All right, so they're no longer like their dual mandate of low and stable prices and full employment. They've met the mandate of full employment. So now, like, his concern is just working on this inflation thing. Inflation slowed in July, which is a very encouraging development. Headline inflation for both the Consumer Price Index and index derived from personal consumption expenditures, the Fed's preferred measure, slowed largely due to continuing declines in the price of gasoline and other petroleum products. Excluding volatile energy and food prices, core inflation for these two indexes also stepped down from the rapid increases of earlier this year, but it's still too early to say that inflation is moving meaningfully and persistently downward. Inflation is still widespread. For both the headline and core inflation, at least 60% of the underlying categories of different goods and services increased by 3% or more. Prices for housing services are elevated and still rising. Core goods inflation continues to run well above the pre-pandemic level. Inflation for services, including housing, has moved up the past year, in part due to the consumer shifting back to more nominal activities outside of the household and social distancing. Activities outside the household as social distancing have eased. Looking ahead, I will be focusing on a number of factors that will influence inflation. On housing services, rent and so-called owner's equivalent rent, I expect to see sizable increases in this component of inflation for a while as the recent rise in new rentals makes its way into aggregate price measures. In a speech in March, I noted that based on various measures of asking rents, some analysis were predicting that the rent inflation and the consumer price index could double in 2022. And so far, it is on pace to more than double. It's pretty scary to think about. Owner's equivalent rent is similar on pace to nearly double this year, sometime early next year. Though I expect to see the upward pressure on inflation from these forces to ease as future increases in new or renewed leases moderate and the full effects of monetary policy tightening make their way into housing services prices. Beyond housing, I expect goods price inflation to continue to moderate as monetary policy now and going forward slows the pace of increase in aggregate demand. Supply problems ease, and supply and demand come in better balance. This is some of the evidence that goods supply production and delivery problems tied to the pandemic are improving. You see that everything is about supply. Like they keep talking it over and over again. It's about the supply. It's about the supply of things. Making things easier to supply, to make it easier for the demand. I mean, that's really what this all came down to, was that supply chain breakdown. There is some evidence that goods supply production and delivery problems tied to the pandemic are improving, with supply delivery times and reports of items in short supply continuing to drop. In terms of service price inflation, we saw a step down in airfares and other travel-related services last month, but I am uncertain about these services as well as the food services and non-market services prices will evolve going forward. Nominal wages have been growing quickly, and I'll be watching closely to see how wage growth evolves and feeds into inflation. The Atlanta Fed's wage growth tracker hit another record in July for its 24 years of data, a 12-month rate of 6.7% wage growth. I don't expect wages to increase to ease up much, I don't expect wage increases to ease up much unless and until there is significant softening in the labor market. See, this is what they're going to do. They're going to hit you in the labor market. They're going to take out jobs. They want to see layoffs, and they want to do it to try and ease in the inflation expectations. One way to anticipate future wage growth is through quit rates. Most people who quit their jobs are moving to others that pay significantly better. So I take quit as one signal about whether or where wages are headed in the near future, or in the near term, Quits are near their highest level in over 22 years, and that government has tracked them. In the 22 years that government has tracked them. But they have come down from the start of this year. The further decreases would bring them closer to the level they were at immediately before the pandemic, when wages were growing much more slowly than today. Another factor so they're trying to take out wage growth too. So like everybody who was complaining that the wages weren't keeping up with the cost of living, well, the Federal Reserve is not going to make it any better for you. If you have increased your wages at this point, you've done okay. But if you are anticipating that you're going to get more wage growth going into the future, they're going to create an environment that's going to make that tougher. So anyway, moving on here. Another factor that I will be watching closely is the long-term inflation expectations, which I believe significantly influences inflation, right? Because it's all about inflation expectation. I've said that many times as well, because inflation expectation is a self-fulfilling prophecy. Same thing with deflation. As inflation moved higher over the past year and a half, measures of short-term inflation expectations moved up notably. But measures of long-term expectations rose only a little and generally stand near levels seen in the years before the pandemic, when inflation was low. In fact, several measures of long-term inflation expectations have edged lower over the past couple of months. To me, this means that the public retains confidence that the Fed will be able to rein in inflation in the medium term. To sum up, while I welcome promising news about inflation, I don't yet see convincing evidence that it is moving meaningfully and persistently down along the trajectory to reach our 2% target. I keep in mind that a year ago we saw similar promising evidence of inflation moderating, for several months before it jumped up to the high and then very high levels. Those earlier inflation readings probably delayed our pivot to tightening monetary policies by a few months. The consequences of being fooled by a temporary softening in inflation could be even greater now if another misjudgment damages the Fed's credibility. So, until I see a meaningfully and persistent moderation of the rise in core prices, I will support taking significant further steps to tightening monetary policy. So this is something to think about. Like, even after they see inflation coming down, like a lot of people are arguing that they'll never see inflation come down again, but even if they do see inflation coming down, he said it right there that they do not plan on doing anything about dropping the interest rates right away, that they want to see it persistently. How did he say it? I will support, so until I see a meaningful and persistent moderation of the rise in core prices, right? So even if you see inflation come down, they're going to keep interest rates elevated for some time after that. All right, we're almost done here, guys. Thanks for sticking it out. 546 of you, 120 likes. Really appreciate it. All right, we're almost done here. Now let me lay out the implications of this outlook for monetary policy. Since March, the FOMC has raised our policy target from the near zero to between 2.25% and 2.5%. That puts the upper bound of the current target range at the median of the FOMC participants' longer run projection for the policy rate. As recorded in the June summary of economic projections, this long-run rate is effectively where participants think that the policy rate would settle when the economy is growing at its potential and inflation is at its 2% target. This is a good definition of success when employment and inflation are near the goals and no help is needed from monetary policy. But that isn't the case now. Inflation is far from our goal, so more action is needed. The policy rate will have to move meaningfully above the neutral level to further restrain aggregate demand and put downward pressure on prices. So the policy rate will have to move meaningfully above the neutral level. We don't know what neutral is. We are assuming it's somewhere around that 2.5%. Now, when we were reading the John Williams speech, Monetary Policy for a Low Neutral Interest Rate World, they were suggesting there that the neutral rate was somewhere between 0 and 1.5%. So we may be above neutral now, we just don't know it. And as far as moving meaningfully above it, we haven't even started to move meaningfully above that. So we know by this speech right here, obviously he's only one person who votes on the FOMC. But if this is even remotely close to what the other Federal Reserve governors and presidents are thinking, we know that there's going to be a lot more increasing to the Fed funds rate going forward. All right. Looking ahead to our next meeting, I support another significant increase in the policy rate. Right? He says it right there. But looking further out, I can't tell you about the appropriate path of policy. The peak range and how fast we move there will depend on data, and we will receive about. So sorry, guys. Okay. How fast we move will depend on data we will receive about the economy. Earlier this year, when we were ending asset purchases, inflation was quite elevated, and we were lifting the target range off the effective lower bound. So it made sense to provide forward guidance to help convey the urgency of the FOMC, or the urgency the FOMC felt about tightening monetary policy. So he said it right there. So it made sense to provide forward guidance to help convey the urgency of the FOMC's, how they felt about the tightening of the monetary policy. So that forward guidance is really important. He referred to it a couple of times already, and he continues on. Forward guidance was useful in helping the public understand how quickly we expected to tighten. And we saw long-term interest rates move up quite rapidly as a result of these communications. So they put it out there, and immediately the people started reacting to it and causing the interest rates to rise before they even did anything, right? This is something that people were saying. The Fed has lost control because the markets were reacting before him, but he is saying right there that the forward guidance is what did it, right? And we've been saying it a lot here. Okay, let's see here. And additional hikes should lead to further restraints in aggregate demand. As we continue to raise rates, we need to see month by month how households and businesses are adjusting to tighter financial conditions and how that adjustment is affecting inflation. We shouldn't be estimating what the peak level of the target range will be and how quickly we will get there, because of those details are much more dependent on what the new economic data tells us, or data tell us, than was the case when the only direction for the federal funds rate to go was up, and up by a lot. Oh, okay, I'm sorry guys, I kind of stumbled through that. He was saying there, because the details are much more dependent on what the new economic data tells us than what the case was when the only direction for the Fed funds rate was to go up, up, and up. So they didn't care, like back in the day, what the data was. They just knew that they were going to be lifting interest rates. So they didn't have to be data dependent. They just knew that they were going to be moving up. Okay, this is not to suggest that I anticipate rate increases stopping very soon. I expect that getting inflation to fall meaningfully and persistently toward our 2% target will require increases in the target range for the Fed funds rate until at least early next year. But don't ask me about the policy path, because I truly don't know. It will depend on the data. 6 months ago, I would not have thought we would be where we are today, with inflation so far from our target, after significantly tightening policy with a series of large rate increases and by shrinking the balance sheet. There are a range of possibilities for how the economy will perform. However, and we can talk about the implications of that range. Say, for example, that the inflation follows the path laid out in June by the SEP, which has a core PCE inflation falling to 4.3% in the fourth quarter of 2022, and then moving toward 2% over the 2023 and 2024. In that case, I would support our policy rate peaking near 4%. So a lot of people say, how high are the Fed funds rate going to go? Well, he was thinking I would be in support of policy rate peaking at 4% on the Fed funds. But based on the experience of the past year and a half, it would be foolish to express great confidence that this plausible path will come to pass. Instead, it is important to consider the range of possibilities and the appropriate policy responses. For example, if inflation does not moderate or rises further this year, then in my view, the policy rate will probably need to move well above 4%. Alternatively, if the inflation suddenly decelerates, then in my view, the policy rate might peak less than 4%. So I guess that's if you believe inflation is going to come down or not, right? Whether or not it goes up over 4%. All right, last part here. One thing that is more predictable and has a significant effect on the tightening policy over time is the shrinking of the Fed's holdings of assets as maturity security run off the balance sheet. Starting this month, the Fed is shedding $60 billion a month in Treasury securities and up to $35 billion a month in agency mortgage-backed securities. This action effectively increases the supply of securities in the hands of the private investors and will thus put upward pressure on interest rates, as private investors must now be enticed to hold these assets. All told, the FOMC has taken unprecedented and decisive policy actions this year to quickly increase the policy rate in response to high inflation. But where we stand now is not good enough. Though the labor market is strong, inflation is too elevated. So I support another significant hike in 2 weeks. After that, the tightening path will continue until we see clear and convincing evidence that the inflation is moving meaningfully and persistently down to our 2% target. The pace of tightening is uncertain. It will depend on the data. No matter what, I am ready and willing to do what it takes to bring inflation down. Okay, so thank you for sitting through that. I stumbled through a lot of words and I have a hard time reading, especially something as long as that. But when you go through these speeches and you take into the consideration of the stuff that they are saying, it is very much of my belief that the Federal Reserve has no intentions on dropping interest rates, not even after the inflation comes down. So as people are looking for the inflation to come down, the price inflation to come down, and then the Federal Reserve to respond to that by dropping interest rates again, they're not going to do it. right? Inflation is going to come down and the interest rates are going to stay elevated during that time. It's going to be very painful for people, and they're going to be screaming at the Federal Reserve that they are doing this on purpose and that they don't know what they're doing, right? Well, they are doing it on purpose because they say they're going to do it, but they do know what they are doing because they know it's going to create a lot of pain for people. The people who experience that pain are going to be very pissed about it, and they're going to blame the Fed, but, you know, what do you do? All right, guys, I see there was a lot of comments. I saw there was a super chat up there at one point. Oh, there it goes. Let me see if there was a question with it. Nope. Jaws, thank you so much for the $2.99. You're very supportive. Thank you very much. All right. I would love to hang out with you guys and talk about this for a little while, but I got to go back into work. So let me just get one question right here, and then we'll have to end the video. Hey, UE, if you were Fed chairman right now, what action would you take? That's I mean, to be honest with you, it's not for me to judge. Like, I'm not, I'm not the economist that deals in monetary policy. I'm the guy who's trying to figure out what monetary policy is going to do and how to react to that monetary policy. I don't know what's good or bad for the economy when it comes to the Federal Reserve and their fiat currencies. I honestly think that we should have sound money. I think gold and silver and cryptocurrencies, and hell, why not? Why not even a fiat currency? But I believe that we should have competing currencies. And because we don't have a competing currency, we are reliant on the Federal Reserve and their central bank policies. So what is the right move? I don't know. The right move would to start dealing in gold and silver and cryptos or something like that. But what actions should the Federal Reserve take? I don't know. I mean, I really don't know. I don't agree with central bank policies anyway, so it's hard for me to say what their actions should be because I just don't think that they should exist. So but I think what they're going to do is keep interest rates elevated even after inflation comes down. They're going to kill demand, right? Because they say it over and over again. They want to slow the aggregate demand down, and when they do, it's going to be very painful as layoffs and just business practices, trying to do business. I mean, if you're a small-time business owner or something like that, you're going to be in an environment that is very difficult. So I certainly would not get yourself like loaded up on debt. That would be a very compromising position to be in. Stay out of debt, get your bills paid off, try and figure out a way to save money every month, because I think that's going to be a major problem for people. Because really, it doesn't really matter how much money you make. I mean, it really doesn't. I mean, it's more about how much you can save. That's more important than anything. Okay, I got to go back to work, guys. Uneducated Economist, you let me know.